Hi, welcome to PPM Network, where we make Forex trading simple for everyone. And in today's video, I'll be teaching you Forex basics, perfect for beginners. Alright, I understand that Forex basics can be quite overwhelming, but not to worry, I have a step-by-step guide for you. By the end of this video, you understand what Forex is, why the participants in the Forex market, why you should trade Forex, categories of currency pairs, some common terms in Forex, and finally, how you can get started. Alright, see you after disclaimer. Welcome back again. What is Forex? Forex, short for foreign exchange, is the global marketplace where currencies are being bought and sold. Now think of it like this: when you travel abroad and you exchange your local currency for another, you've participated in Forex. But Forex takes it more further. Instead of exchanging for travel, Forex traders exchange to make profit. Let me give you an example. Assuming you exchange $1 for €1 today, tomorrow that euro becomes worth $1.10. When you sell it back, you've made a profit of 10 cents. Forex traders do this, but on a much larger scale. Trillions of dollars are traded daily. Who are the participants in the Forex market? Alright, the participants in the Forex market are commercial banks, the central banks, Forex brokers, Forex dealers, hedge funds, retail traders like you and I. Now, the above participants in the Forex market participate in the Forex market with the sole aim of making profit, except the central bank. The central bank doesn't participate in the Forex market with the aim of making profit. They only participate in the Forex market with the sole aim of stabilizing their national currency value. They do this by selling or buying their currency in the financial market. Let's take for instance, if a country currency is too weak, the central bank may buy its currency in the Forex market to increase demand and strengthen its currency. Likewise, when a country currency is too strong, the central bank may come in and sell their currency to weaken it, by so doing making exports cheaper and boosting their economy. Every country have their central bank. The Central Bank of America is called the Federal Reserve. The Central Bank of England is called Bank of England. The Central Bank of Japan is called Bank of Japan. Number one reason you should trade Forex is because Forex is the biggest financial market in the world. Over $6 trillion is traded daily. So with the right strategy and in-depth knowledge of how the market works and with effective risk management, you can have your slice of cake from it. Number two reason you should trade Forex is because of its accessibility. You don't need millions to start. With $200, $100, some broker even let you deposit $50 or less to start. Now, number three reason you should trade Forex is because of its flexibility. Now, the Forex market is open 24 hours a day and 5 days in a week, so you can trade at your convenience. You can trade at home, you can trade at work, you can even trade while on vacation. All you need is an internet access and a smartphone. Now, let me quickly say this: for the fact that the Forex market is open 24 hours a day doesn't mean that you can trade anytime. We have three major trading sections. We have the Tokyo section, we have the London section, and we have the New York section. The London section and New York section are known as the most active trading section. Why? Because they have the highest number of participants during that time. Alright, let's talk about currency pairs. Currencies in Forex are traded in pairs like Euro USD, the Euro against the United States dollar. Why? Because Forex is all about comparing the value of one currency to another. Let's assume we have Euro USD, Euro against the United States dollar. Alright, let me break this down. When we have Euro USD, Euro is the base currency, while USD is the quote currency. Let me break it further. Let me tell you what it means when you place a buy order or a sell order. Now, when you place a buy order on Euro USD, what it means is that we are saying Euro will be strong and the United States dollar will be weak. So it means that we are buying the euro and we are automatically selling the dollar. So it is simultaneous. You are buying one, you are selling one. So what does it mean when you place a sell order on Euro USD? What it means is that when you place a sell order on Euro USD, it means that you are buying the dollar and you are what? Selling the euro. That means you are saying the dollar will be valuable, the dollar will be strong, so you are buying it and you are what? Selling the euro. So that's what it means when you place a sell order. I hope I've been able to clarify this. Alright. Currency pairs are grouped in three major categories. We have the major pairs, the minor pairs, and the exotic pairs. Now, let's talk about the major pairs. The major pairs is any currency pair that involve the United States dollar and have high trading volume, like the Euro USD, the USD JPY, the GBP USD, the Australian dollar, and the United States dollar. The next one, we have the minor pairs. Minor pairs don't involve the United States dollar, but still include major global currency of the world. Like we have the Euro GBP, we have the GBP JPY, we have the GBP card, we have the Euro odd, we have the Euro card. Alright, let's talk about exotic pairs. Now, exotic pairs consist of one major currency and a currency from an emerging or smaller economy. Example of exotic pairs, we have USD, and the Turkish lira. We have the USD and the Singapore dollar. We have the Euro and the South African rand. Now, why are they called exotic pairs? They are called exotic pairs because they are less traded in the Forex markets compared to major pairs like Euro USD or GBP USD. Another reason why they are called exotic pairs is because they are volatile. They are highly volatile, which means that they move fast due to the fact that their exchange rates change quickly. And another reason they are called exotic pairs is because they have wide spread. The difference between the ask price and the bid price is wide, which makes trading costs higher. Now let's talk about some common terms in Forex. Alright, under these common terms in Forex, I'm going to be explaining spread, leverage, margin, pips, and lot size. Now let's start with spread. What is spread? Spread is the difference between the ask price and bid price. Now the ask price is also known as buying price, while the bid price is known as selling price. Imagine you walk into a candy shop and you ask the shopkeeper, what is the cost of buying candy? And what if I change my mind to sell it back to you? And he says, to buy candy costs $10, but if you change your mind to return the candy back, it's $9. You see, 10 minus 9, that's 1. That's the difference between the buying price and the selling price. So that difference is the spread. That difference of $1 is the spread. That's the amount the broker charge you whenever you open a trade. Alright, now let's talk about leverage. Leverage is your borrowing power. Your borrowing power to make a bigger trade. Alright, let's make use of this analogy. Let's assume you need a $10,000 car for the weekend, but you only have $1,000. The car company says, alright, don't worry, we know you need a car of $10,000 for the weekend, but you don't have up to that, but you have $1,000, right? Okay, not a problem. You can deposit that $1,000 and take the $10,000 car for the weekend. Now that deposit is your margin. So trading, leverage lets you control a large trade size with a small amount of money. Example of leverage, we have 1:10, 1:50, 1:200, like that and like that. Now, what does 1:50 means? 1:50 means that for every $1 in your account, you control $50 in the Forex market. So what does that mean if you have a $100 trading account with a 1:50 leverage? What it means is that with a $100 account and the 1:50 leverage, it means that you control 50 times the $100, which is what? 100 times 50. Now do the math. That is what? That is $5,000. Now let's talk about margin. What is margin? Margin is your safety deposit. Still continuing with the car rental analogy. The $1,000 deposit is the amount of money you need to keep the deal active. In trading, the margin is the amount of money you set aside in your account to open and maintain a leverage trade. Now let's talk about PIP. PIP means percentage in points or price interest points. It's used by traders to calculate their profits and loss, how much they make in the trade. Now for pairs like EURUSD, GBP the PIP is the fourth decimal. Let's assume EURUSD is at 1.20000 and it moves from 1.2000 to 1.2001. Now that is 1 pip. But for pairs like Japanese yen, the pip is on the second decimal. Let's assume we have USD JPY at 120.45, and if it moves from 120.45 to 120.46, you see that it has moved a pip. So that's the pip. Lot size is the unit size you are trading. Examples of lot size: we have micro lots, mini lots, and standard lots. Micro lot is from 0.01 to 0.09. What does 0.01 lot means? 0.01 lot means you are buying 1000 units of the base currency. 0.02 lot means you are buying 2000 units of the base currency. And we have mini lots. Mini lot is from 0.1 to 0.9. What does that mean? Mini lots means that you are buying 10,000 units of the base currency. So let's assume you use 0.1 mini lots. It means that you are buying 10,000 units. If you use 0.02 lots, it means you are buying 20,000 units, like that and like that. Now we move to standard lots. Standard lots means you are buying 100,000 units of the base currency. Like we have 1 lot, 2 lots, 3 lots. 2 lots means you are buying 200,000 units of the base currency. Now, the type of lot you use is dependent on 2 factors. Now, what determines the kind of lot size you use? The kind of lot size you use is dependent on your trading account and on your level of experience. For instance, you can't use a mini lot or a standard lot on a $100 account. Why? That's just too much. Using a mini lot or a standard lot on a $100,000 account on a $100 account is too much. Why? Because a small move against you can wipe a huge percentage, if not all, of your capital. So when you are just starting trading, stick to micro lots. Alright, in the final section of this video, how to get started. How do you get started in forex trading? Number 1, choose a broker. Make sure your broker is reliable and reputable. They are transparent to ensure a seamless trading service. Open a demo account. Also, another way to get started, you have to download trading platform, MetaTrader 4, MetaTrader 5, and open a demo account. Practice on a demo account before risking real money. Alright, thanks for watching. We've come to the end of this video. Please, if you find what I've said in this video helpful and valuable, please do well to like, subscribe, and share. And also, if you have any question, please drop it in the comment section. Bye.